All right, everyone. It is my great pleasure to bring on some folks from NASDAQ. Actually, in particular, I have the head of index options at NASDAQ, John Black. And with us also is Joseph Cusick, VP Portfolio Specialist at Calamos Investments. How is it going, gentlemen?
It's great. Thanks very much. Thanks for having us.
Yeah. Great to have you guys here. All right, so we've had some of y'all on previous boot camps, and people really enjoyed it. So you guys know how to do the thing. You can see the chat, if I'm not mistaken. Can you see the chat? If not, I'm going to be your liaison.
I cannot.
Okay, no worries. I'm going to be your liaison. I'm going to make sure that chat's questions get answered by interrupting you, which I'm really good at doing. Otherwise, I want to hand it off to you guys. Introductions, let folks know who you are and what they're about to learn from you.
Great. Thank you very much. I'll share my screen for just a quick minute. Let's see. Share screen. Oh. Let's see. See if that worked.
You're good, John.
You're good? Can you guys see?
You're on, bud.
Yeah, I got it. Here we go. All right. Let's see. Give me 1 second here. I'm just going to stop screen share, but the first thing we had was a disclaimer up there from NASDAQ. It's on our indexes and our options, and everything we're doing here is for educational and informational purposes. We're really excited to be here on the Benzinga Network again. At NASDAQ, my role is the head of index options. As mentioned, I support a team that leads the business development for our index options products. We have our flagship NASDAQ 100 and the index options on that. We have NQX, which is our reduced value index options. And finally, we launched XND, which is a micro index option with a $16,000 notional for smaller size portfolios for more precise hedging. And we're really excited about these products. We've been working with the marketplace, institutional and retail customers on the proper use case for index options for portfolio risk mitigation and yield enhancement. We're really excited to be here and have Joe with us today. Joe's the Vice President Portfolio Specialist at Calamos. And he utilizes these products for his customers and the products that he manages at Calamos. And he's really good at breaking down how we should properly use index options for portfolio management. So I'm really excited he joined us today and is going to go through some of his presentation. So I'm gonna go on mute. I'll be here in the background if there's any questions. But thanks again, Joe, for being here.
Hey, John, thanks. Benzinga guys, thank you so much. It's great to be here on a Saturday morning. I'm going to actually share my screen. And if you just give me a minute. Okay, John, you should be seeing this screen right now. Perfect. Okay, so welcome. As John said, I work at Calamos. I've been in the industry for 27 years, started as a market maker here in Chicago. And then throughout the course of my career, the bottom line is I've used options the whole entire time, whether it was as a retail customer, building a retail firm, and now I'm using it as part of our overlay strategy here at Calamos, where we have over $40 billion in AUM. And we're utilizing index options to do a variety of different hedging, income, and so forth. So what I wanted to do this morning was to really just walk through how a retail trader, retail investor can look at options and think about how you can use them for income and hedging strategies. As John said, the NASDAQ has a variety of products that you can utilize and new products. It's really exciting to hear, John, that you're working on those. And so why is it important to really look at the options industry? And, the industry, this is the fastest growing industry, both for retail and for institutional. You can look at the growth of new funds that are coming into this space. Specifically, we're looking at it in terms of utilizing a manager that's using an overlay strategy, selling calls, buying puts, doing spreads, things of that nature. And as of mid-year this year, 5.4 billion of new assets have come into this options-based category. just on the fund side. And then 2020 alone, there was 8.1 billion. So you can see that we're almost at 2020 levels, and we're only halfway through the year in this graphic. So what are the potential benefits of deploying an option strategy, right? You can create income outside of dividends. You can reduce your portfolio or position volatility. You're going to capture defined upside participation, right? You're going to limit downside, and you're going to have daily liquidity. So why would you use this? Who's going to benefit from this? Who on the Bazinga platform is going to benefit from the utilization of, options, whether they're single stock options or index options? Well, an investor that has a concentrated position, right? You own a ton of one stock and you're looking to buffer that downside risk. Hey, we're at all-time highs. Volatility out until the end of this year and into the first 2 quarters of next year is forecasted in the mid-20s and looking at the volatility indices. You're also looking to enhance a return or a projection, right? You want to have better risk-adjusted types of returns as well as total returns. And then this could be something that when stocks hit all-time highs in 30 days, how do you, in a less subjective, non-emotional way, allow your stock to be called away at a price target, right? Let's say 10, 15, 20% up. It's amazing how these stocks have been moving. The problem is when they do make those moves, you get emotional. And when they do hit those targets, you think you're going to get another 10 or 15 or 20% in 30 days. So the bottom line is that you have to develop the skill sets, the tool sets, the process, right? So that when you have that process in place, you can manage properly option strategies that can support multiple allocation goals, right? So let's say, for example, you're concerned about the volatility in an upcoming market, whether it's a general index or an individual stock. How do you manage that type of volatility risk in that holding or for your portfolio? You could do things like cover calls, sell a call against your holding, right? This is where you're putting a price target and when you want to sell. Now, until it reaches that target, you're going to receive a premium. So at the end of the day, even if it doesn't reach this price target, you're taking an income. The other thing that you can look at is you can manage volatility. When you're selling calls and buying puts, you have the ability to basically say, this is my floor, this is my ceiling, this is my floor. So if the markets start to move dramatically in one direction or in both, you're going to have a ceiling where you're saying, okay, I'm going to capture income, and you're going to have a floor where you're saying I have insurance. These are critical components of the options marketplace so that while you use all of the other tools, I heard Mark talking about technical analysis. That's a great tool to get a sense of what's been going on in the market. But this is where you can start establishing forecasts and utilizing these derivative products, not only for your holdings, but look, if I just buy call, sell call, and buy put, you have a spread, right? Now let's walk through some hypothetical illustrations. All right, let's say, for example, you own a stock. It's been a great dividend payer and continues to be. And as a matter of fact, going forward, with interest rates basically at zero, dividend stocks are going to be very, very in focus for both institutional and retail. So let's say, for example, that this stock pays a $2.06 dividend. Does this 4 times a year. That's $8.24. That's 2.2% for the stock. Now, that's great. You get an excess income of 2.2% on the dividend. But what happens if I just start selling calls to increase that income or that potential the income? So we're going to sell an out of the money call. Let's say that it's trading at $4.30, okay, or $4.58 in this graphic, but $4.30 here. If in fact by expiration that option goes out worthless, you get to keep 1.17% in income. That means that you've made half of what you have to wait on an annual basis in 1 month. Okay. So basically, on a rolling 30-day schedule, and over a quarter, you could potentially pull in by just selling calls against your stock and still leaving upside. $30 of upside in this case, you'll make an excess return of 3.5%. That's almost 11% excess return annually, right? And so again, all you're doing is you're saying, I'm willing to cap my upside at 9% over a rolling 30-day period. So when you look at this, you're saying, okay, I'm bullish on a stock, right? I know that I have a dividend. And the bottom line is that I want to increase that dividend or that income, and I'm willing to trade off upside. How do you do that, right? That's with a covered call. Now you're looking at this saying, I don't want to buy the stock right away. I want to actually participate in the market, but I want it to pull back. I think the market's too frothy. Let's use cash secured puts. This is where you go in and you sell a put. Now, a put, when you sell it, obligates you to purchase the stock. Now, while you're waiting for the stock to pull down and to the strike price that you're selling, you're getting paid. That's that income component. If it never comes down to this level, I don't own stock at $67.50. I collect $315, which is the premium I received, right? And so the bottom line is that when you think about this, you're like, wait a minute. Market's at all-time highs. I may like this security, but I'm looking at my charts. I'm looking at the fundamentals. I just don't like this price point. Sell out of the money puts. For every one contract you sell, that's 100 shares of stock. So if you get one contract, and it goes below 67.50, you own stock at this price minus the $315, which is 64.35. So if the stock's trading at 70 and it goes down to 67.5, and you liked it at 70, you're loving it at 67.5, you're absolutely going to adore it when you're owning it at 64.35. And the best part about all this is that at the end of the day, you're able to purchase stock at a discount from where it was originally trading. And if it never gets to this point, in other words, the stock doesn't dip down, no harm, no foul. You still make income. Now, over here on the right-hand side, some of you option experts, you'll see this little matrix here. And I put this together just to show you that once you develop your sentiment, right, whether you're bullish, bearish, or neutral, and you have a good hold of what implied volatility is doing, that forecast of potential movement in the underlying, you can look at this and see what the most optimal trade strategy would be. And today, again, we're talking about the cornerstones, short calls, short puts as income strategies. And you can see here, if volatility is high and you're bullish, selling puts could be an optimal strategy. All right, now I want to switch a couple gears. And the bottom line is that let's say that, and John, I apologize. We do this with the NASDAQ and the S&P 500, so I apologize. This should have been NASDAQ, but this was an older one. Bottom line is how some of you might ask, okay, Joe, I already have a huge portfolio. I want to hedge it out. So let's say you have exposure to a broad-based number of names. In other words, you beta weight more to the S&P 500, or let's say you own a lot of technology stocks. A quick way to ascertain how many index options you need to purchase to hedge your portfolio, and this is buying puts in this case, you take this formula. The size of your portfolio, your beta weight to that portfolio. So let's say, for example, what's a beta weight? It beta weights to a specific index. So if you're concentrated in the NASDAQ stocks, tech stocks, you basically could look at this and say, okay, I have 5 of the big ones, beta weights to 1, so to the NASDAQ. So if the NASDAQ goes up 1%, your portfolio goes up 1%. If the NASDAQ goes down 1%, your portfolio goes down 1%. So you take the amount of your total portfolio multiplied by your beta weight, and then the multiplier. In this case, the index has a multiplier of 100, and then the price of the index, right? That will then give you the number of index puts that you need to purchase to hedge out your portfolio. So let's say you own this a basket of stocks, and the underlying index that it tracks is at 29.25. And you basically want to say, I don't want to lose more than 4.5% to the downside. So you buy the at-the-money put, the 29.25 strike put. Basically, you can think of this as being analogous with buying car insurance with a 5% deductible. So you go in, you basically say, I have a portfolio of $1.1 million. It benchmarks, in this case, the S&Ps, but let's say it's also to the NASDAQ. The potential solution is take the size of the portfolio, multiply it times the beta weight, which most platforms, your trading platforms, will have that on there with your portfolio. And the bottom line is that then you divide that by, in this case, 100 times the index price, and that gives you 4 contracts. So that means that you buy 4 December contracts. That gives you protection throughout 12 months of the year. And for that, you have to pay $12,260. So the bottom line is the cost is 4.2%. That's your maximum loss through December 31st. This is how you can utilize derivatives to hedge out your portfolio holistically. If you're concerned going into a year where it's been all-time high, all-time high, all-time high, and you're not ready to sell some of that froth, well, the bottom line is that you can hedge out using index options and just use that simple formula. I'm going to leave you with three just takeaways for the remainder of this year. One other thing that you can do is implied volatility for most of you on this chat or this Bazinga portal. You probably have gone through this where you're able to use implied volatility to forecast expected ranges or expected price changes. And really, if you just take this general, now there's a little bit more robust formulas, but I wanted to simplify this. Is if you take the current stock price times the implied volatility, and then take the number of trading days divided by 365 in that square root and multiply these two sums together, you're going to get a trading range that's being priced in for, in this case, I'm looking at 1, 7, and 30 days. Why is this really beneficial for all of you on this chat, on this call today? Bottom line is that this is where you get transparency. It's great to use fundamental analysis. It's great to use technical analysis. But the bottom line is why not utilize a forecast that's built into an option that prices in the potential range of an underlying that drives the price of that option, right? In other words, market makers build that into an option price because what they would need to do is they need to be able to hedge out the risk. So they need to forecast what the potential range is in a stock. Well, why not use that to our advantage? So I'm giving you basically the price ranges from now until the end of this year, 12/31/21. So if you look at the S&P 500, it's a 192-point range or 4% for the remainder of the year. You have the NASDAQ 100. That's a 788-point range or 4.8% a year. And the Russell 2000 has a 135-point range or 5.7%. Bottom line is that 68% of the time when you look at a normal distribution, these indices should stay within this range. Now, there's an asterisk to this. This is a dynamic calculation. So as markets move, in other words, price changes, days to expiration pass, and implied volatility shifts, guess what? These will move. But this is great context. So when you're looking at a specific pattern or support and resistance, or you're thinking, wow, they're pricing in a 6% move in the NASDAQ between now and the end of December. Well, the market right now, those that provide liquidity in some of the biggest markets, whether it's the NASDAQ or the S&Ps or the Russell 2000, they're not forecasting a 6% range. They're forecasting a 4.8% range. So if I don't see it go outside of this range, I'm feeling pretty confident that things are normal. All right, with that being said, I'm going to stop sharing. And John, I know I've taken up a ton of time, and I'll just throw it back to you and see if there's any questions. You're on mute, bud.
Sorry, I was stuck there. We'll kick it back out to the Benzinga team and see if they have any questions in the chat for us.
Yeah, we had a couple questions about the stuff you were showing on screen. So Joe, if you wouldn't mind going back to a couple slides, we
Sure.
wanted to know some of the tickers that you were looking at.
Sure. So basically, I was just using indices. I was using the NASDAQ, the S&P 500, and the Russell. So SPX, NDX, and RUT. Those were the primary tickers that I was looking at as far as these estimated moves are concerned. And again, the biggest thing that you want to walk away from today, and I'm sorry, I meant to share this. The biggest thing that you want to walk away from today is that when you look at these broad-based indices, you got to think of them in two ways. And one is these are indices that basically have all of the names that we typically would trade. The Apples, the Microsofts, the Oracles, the IBMs, right? They're all in one or both of these different indices. And then you have the small caps. The other thing is that these offer you the ability to trade the broad-based market. While it's sexy to trade the meme stocks and individual securities, often you get into environments where it's almost untradeable, some of these names, because of the volatility that's in them. And you also don't have that ability to kind of mute volatility as you can when you utilize index options. The final thing is from a tax perspective, and that's why I was excited to hear that John and the NASDAQ's coming out with minis. From a tax perspective, these actual options, whether you trade them one day or you trade them 12 months in holding period, they have favorable tax treatment. In other words, 60% of the gains is long-term and 40% is short-term. And I know you have a lot of active traders on this webcast. Finally got that term right. Sorry, it's Saturday morning, man. But the bottom line is that you have a lot of active traders. And while, we don't trade based on taxes per se, I mean, we at the fund, we have to think about that. But as an individual, if you can trade an NDX option and make, a 50% return and have 60% of that in one day long-term capital gains, that's pretty significant if you're trading, 20, 30, 50 times a month.
Yep. And I just want to pipe in a little bit on this exact topic. This is a theme for the day that I think everyone should be mindful of. I'm personally still mindful of this. If you're getting into territory that's very niche with a specific stock, with a specific strategy on a short time frame, or using one indicator that's not like really that popular or something like that, and you're not exactly succeeding, and then you take a look at these indexes, and you don't know how to trade those, I think that's a time to take an inventory of yourself and how you might be overextending yourself. Because if you don't know how to trade the overall markets, with the S&P 500, NASDAQ 100, Russell 2000, which are those smaller companies, if you don't know how to trade those, you're not ready to be doing something that's so volatile as an individual stock or a meme stock, for goodness sake, which has an entirely different or unique market structure of buyers and sellers that are changing that price. So I want to ground everybody and say, a lot of the folks that identify as advanced are not. And if you can't trade the indices, you need to figure out how to do that. You need to learn how to do that. Start there before you start getting into stuff. Remember, if you get too greedy, you're really setting yourself up for a lot of risk that usually comes to fruition. Question here. Can you show that expected range calculation formula again?
Sure. It's right there. So basically, this basically will price in a one standard deviation move. So that's why I was, hate to get into stats on a Saturday morning. You might ask, well, what's this 0.05, 0.13, and 0.28? That is the 1 day divided by 365 and then taking the square root. And then to find the implied volatility, you can find that on any trading platform that you're utilizing. You can probably go to the NASDAQ site where they'll have these type of Greeks available, the implied volatility, and then this current stock price. Very straightforward. Basically, it gives you an estimated move on that time frame at that moment based on these inputs. So it is a dynamic calculation, but it's great context. I mean, you were just talking about support and resistance in stocks, right? And looking at breakouts, and you're using your patterns. Well, the great part of this is that after you've done that assessment, you go in and you say, okay, what's the options marketplace pricing in for that underlying? And now you have context, right? You have context where you're like, okay, if it breaks out and it goes up more than, 1.5%, which was the estimated move, that's something significant. That's something that the marketplace, those that provide liquidity, that are trying to make a living trading this stuff, and let me tell you something, they have to be efficient, right? Otherwise, they're going to get killed. Mm-hmm. The bottom line is why not utilize that to our benefit? Put another arrow in the quiver and say, hey, now I have context to what I see as a potential setup.
And I'm not sure, John or Joe, who's best for this one, but a question about how taxes play into sort of what you guys are talking about, as well as what an individual retail trader should be thinking about in that
So
arena.
sure, I could take a stab at it first. But one of the things in the disclosures is it's not this is for educational purposes. The index options that we have on our exchange are subject to possible Rule 1256, which, as Joe mentioned, was 60/40 short term versus long term. We are not tax advisors. Everybody should speak to their tax professional as to the type of account, whether it's an IRA or it's a personal account. So like to know which tax benefits will point to which products, but the products themselves are eligible for that 1256 tax rule. Joe, I don't
Yes.
know if you add.
Yeah. Yeah. And John, that's an excellent point. Always, first of all, always work with your tax advisor, especially as you're using derivatives or if you're trading more actively, right? There are classifications as you get more active in your trading. You have the ability to potentially put yourself as a professional. So take advantage of the opportunity to review that and put that in part of your process, right? As John said, 1256 contracts on our funds and our overlay funds where, I'm on a team that manages, over $20 billion using option overlays on equity sleeves to mitigate volatility risk as well as, generate income. But the long and short of it is that for index options and specifically cash settled index options, the ones that we were referring to, the NDX is one of the notable ones. Those are 1256 contracts, as John said. But if you look at something like the broad-based ETFs, the QQQs, the SPY, and the IWM, they don't get the same type of tax treatment. So when you hear John or somebody from another exchange talk about how they're bringing out micros and minis and smaller contracts, pay attention because those are contracts then that now fit within your scope because the big contracts, the original contracts, were really designed for institutional. And now you have the ability to take advantage of that product and the tax consequences. If you are trading single list options and stocks like, Apples and so forth of the world, if you trade options, those are always going to be ordinary income. Just remember that. If you trade stocks and you don't hold them more than 12 months in a day, that is going to be taxed at an ordinary income rate. In other words, short-term capital gains. And not that you make decisions based on that totally, but once you understand that, then you look for opportunities. Well, how can I somewhat buffer that or mitigate that? That's where the index options come into play, specifically the cash settled indices that typically have that favorable tax treatment. So as far as that's concerned, that's how I would look at it. And then there's plenty of information on multiple websites. I bet you Bazinga has a ton of tax information on there. But yeah, that's how I would answer that question.
Mm-hmm.
And John, it looked like you were doing something on your slide deck. Did you want to share something?
Yeah, sure, definitely. I was really excited that Joe brought up the portfolio sizing, and he just brought up the micro products. So at NASDAQ, we've recognized a couple things over the last year or two, and that was through polling our audience, surveys, product questions, conferences, that people we've spoken to, was the appetite for a couple of things. One, as Joe showed in his graph, like options in general have really kind of entered mainstream. We see it in financial media presentations. There's more and more retail investors coming to the options product, and secondly, the attraction to the technology stocks and some of these high flying elevated price target names. And what we recognize is there's a need for education and things like this, and partnering with Benzinga, having Joe come here, really educating customers about proper use of options, what they were designed for, risk mitigation, yield enhancement. And from our product lens, as Joe said, a lot of the cash settled index options, NDX, some of our competitors, they carry a high notional value. So it's difficult to come on an event like this and say, you know, NDX is the perfect hedge for your portfolio. It carries a 1.6 million notional value. And as in Joe's grid where he showed, you know, how you size your portfolio, it's kind of hard to tell, you know, a sub $1 million account that's an instrument they should be hedging their portfolio with. So we designed NQX 2 years ago. It was, you know, it's about a $320,000 notional product. It's gaining some traction within the institutional and some high wealth accounts. But really this year we launched this XND product, which is you can see up on the screen, and that's 1/100th the value of the NASDAQ 100. So there's a ticking index XND, which ticks with the NASDAQ 100 point for point. It's just 1/100th the size. And then we have our options. We have our options listed on that. We have monthlies and Friday weeklies. The monthlies go out 6 months. The weeklies are the front 6 weeks. And here's the stats on that product. It's 1/100th the size. When we designed this, it was NASDAQ was at 13,000. Now it's at 16,000. But it gives people a more ability to more precisely hedge their portfolio, much like on Joe's grid. If you took the notional value of that index and then divided it by the contracts and the multiplier, there's tons of information on NASDAQ.com about this product. We fully support it. We have educational tools. We have something called the Options Architect on our website. If you search for XND NASDAQ, you'll find it. And that has a back testing capability. You can see how different option strategies have performed over the course of time in stressful market times, in boom market times. You can pick your own dates, and you could backtest different strategies. You can look how a put spread, a 1x2 put spread, a bear credit spread, like different things you can figure out, and you can just learn about all those strategies. And we feel it's really important to make sure that this level of education is out there for these new option traders to better understand the products.
Yeah, and you know, I'd like to weigh in for a second on that. First of all, John, I didn't even know you had that tool, which is awesome. And I'm going to have to take a look after this discussion today on that. But I think John just brought up a really important point, which is utilize these tools. Try to figure it out, because this graphic that I just pulled up here, I think you should see it right now. Do you see that, John? Yeah. This was pulled from a study that was done by a gentleman by the name of Carlos Chujoy. And Carlos ran the Dallas Teachers Pension Fund. And one of the things that we were building off, and I was trying to use a tool like what John just told us about, we were doing it pretty much so by pulling it and building it ourselves. But bottom line is that you have to understand that not all option strategies work in all environments. And this graphic shows you that based on the volatility environment you're in, or what we'll call a regime, and the business cycle we're in, right? Whether it's recovering, contracting, slowing down, or expanding, or vol high or low, not all option strategies, as listed down below here, work in all environments. And so, as John said, I think it's critical that you do your homework and you look at first of all, what is your objective? What are you trying to do? Are you bullish? Are you bearish? Once you've determined that and you find a strategy that you're looking at, you go, okay, I'm bullish and I'm thinking about just buying calls. Well, what happens if, buying calls may not be the most optimal strategy because volatility is high and, we're in a expanding, business cycle, and you look at the performance of a long call and you go, well, wait a minute, maybe I should do a call spread. And you plug that into the tool that John just talked about, and you may see that may be a more optimal strategy. Thus, you're now having better risk-adjusted returns by utilizing a tool. And again, you're still utilizing the typical process that you would use before with technical and fundamental analysis. Now you're going to enhance your potential performance, reduce risk by using a tool and understanding the environment you're in, both from a volatility and business cycle. So I just wanted to bring that up, just so how you can get some context on when you're using tools. Make sure you're using the tools not to just say, I want to make as much money as I want, but you're saying I'm trying to drive the best risk-adjusted and total returns that I potentially can. Because that's how we look at it as fund managers. And one last thing I'll bring up, just so you can kind of, all you on this, you go, yeah, I've heard about options. I may even use options every once in a while, but really it's not my game. It doesn't really matter to me. So why should it matter to everybody on this call? And I think I just froze up. I am frozen, so I apologize, John. I'll throw it back to you. But basically, what I wanted to just bring up was the fact of the matter is that institutional utilage of options from 2006 to current date has increased to 30% of their allocation, meaning that those that are managing your 401ks, those that are managing billions and even trillions of dollars, at the end of the day, they're utilizing derivatives. Retail, only 2% growth in the same time frame as of 12/31/20. So there's a lot of opportunity for all of you on this call to take advantage of these vehicles and the tools that are out there to really help you drive better risk and risk adjusted and total returns.
Drop
Thanks,
the mic,
Joe.
Joe.
Appreciate
John, any closing remarks?
Yeah, no, I think along the same lines as what Joe was just talking about. When I started in the industry and I worked for in the institutional brokers, and so those were the main folks using options for portfolios. It was institutional, and now a lot of the technology that's available to retail, and I would assume a lot of your active traders here at Benzinga, a lot of the tools that are available to them are better than the tools the institutional traders had at the time. It's really become democratized. Joe, probably when you were a practitioner at that same time, like the tools that are publicly available are phenomenal. And that's why we brought the Options Architect to market, so people can see from an education perspective just how these strategies perform and really have information that they can trust, that they can look at. So I think it's all about education and getting the right things to folks that want to use options. So we're excited to be here and we really appreciate it. Thanks, Neil.
Yeah, John, Joe, fantastic stuff. I totally agree. The tools, the assets are there now for retail traders. This is a momentous time to get in and find opportunities using stuff like this. The biggest step is just understanding what you're doing. So getting that education. And so that's why I really appreciate you, Joe and John, for coming on here and providing that and letting us know the stuff is available and how you might use it. You guys have been great.
Thank you very much, Neil.
Thanks, Neil. Take care, guys.
All right. Take care. Have a great weekend.